Hello, everybody, and welcome to today's webinar, where we're going to talk about PPP loan forgiveness considerations and the accounting and tax impacts of PPP, specifically on government contractors. My name is John Carpenter, and I'm joined today by three of my associates, who I'll introduce here in a second. We appreciate you taking time today to dial into this webinar. We will be open for questions, and due to the expected number of questions, I expect that we will probably send you follow-up answers after the webinar is completed. So joining me today is one of my co-workers in the government contract industry group, Danielle DeSonia, as well as Craig Hunter, an assurance audit partner in our government contracting practice, and John Ure, a tax principal in our government contracts practice. So what are we going to cover today? We'll have an update on just an overview of PPP forgiveness, some of the most recent changes that have come out, what's going on with the timeline, some things like that. We're going to spend a good bit of time talking about how PPP impacts different contract types and the possible credits that contractors may owe back to the government, depending on how your contracts are structured and the nature of your PPP loan. Craig is going to cover cost accounting and GAAP accounting considerations related to PPP, and John will be talking about some of the tax issues that have arisen and continue to arise in the PPP program. So I'm going to first turn it over to Danielle to talk about some of the updates and recent events happening in the PPP program. Danielle, it's all yours.
All right, thanks, John. So I'll kind of talk about where we stand, like you said, the timing considerations, and then tricks and traps, not so much tricks and tips. So it seemed like for a while over the summer, we were getting new guidance every day, every week. I mean, it was just nonstop. It's kind of slowed down. We haven't gotten much since about the middle of August. And all of that, just as an aside, is available for everybody on the SBA website. So I encourage everyone to check that out frequently to make sure you're up to date on the latest. So the SBA portal did open up and start accepting applications August 10th. And there are some banks that were open and ready to go on August 10th. Now, we're in touch with a lot of banks, and I would say at least half of them are not yet accepting applications. So, I mean, it's been over a month since the SBA has technically been accepting them, but if your bank's not ready, you know, you can't apply yet. So we think that most banks will be up and running within the next 3 to 4 weeks. So keep an eye out for communication from your bank on when they will be accepting the application so that you can be ready to go as soon as that portal opens up. As far as the timing goes, on the bank side, they have 60 days to render a decision. So that means you could submit your application tomorrow, and you may not hear back from them until, Thanksgiving almost. So it seems like a long time, but, each bank is dealing with thousands of loans, so they need time to dig through them all. And then once it gets to the SBA, they've got another 90 days. So, I mean, this thing could go on and on until early or mid next year if everybody takes their time with it. Some of the tricks, what we've been seeing, the biggest thing is documentation. If you can keep organized documentation and pay attention to those required documents and have those ready to go for the bank, you're going to be in good shape. A lot of the issues are just missing documentation because people just do not know what they need to submit. I would also say to do some calculations on your own. Cherry Bekaert has been helping our clients with a lot of these calculations over the last couple of weeks, and that really helps avoid any surprises when it comes time for the bank to make their decision. Another trap, I would say, is owner income. We're going to go over that in the next couple of slides, so we won't touch on that here. Another big trap, I would say, is the FTE calculation, or the full-time equivalent employee calculation. For a while, that was not defined, so we were stuck kind of guessing what a full-time equivalent meant. But they've since defined it, and that's going to be really important, especially if you're not filling out the 3508 EZ and you're filling out the regular 3508. So you need to look at your FTEs for your covered period and then for some reference periods. And we'll get into that a little bit, but if you have questions on that, reach out to us or your advisor. So the first section and the biggest section we'll talk about is the payroll costs incurred or paid. Now, we're talking about the PPP, Paycheck Protection Program. So payroll is obviously an important one here. Each employee can be in, their salary and other compensation can be included to $15,385,000 if you're looking at an 8-week covered period. If you're going to a 24-week covered period, you're looking at $46,154. Now we get those numbers by dividing $100,000 by 52 weeks and then multiplying that by either 8 or 24. It's a little bit different when we're looking at the owner employees. The $15,385 doesn't change, but if you're extending to the 24-week covered period, those owner employees are capped at $20,833, and that number comes from $100,000 divided by 12 months times 2.5 months. And the reason behind that is that's what the owners were included in on the origination phase. So they wanted to cap them at the amount that they were originally included as, to not overcompensate the owners rather than the employees. You can see here you can include reasonable bonuses. Obviously you can't go too crazy with that or you're going to be over those caps. And then another thing that we cannot include here is mandated FSCRA paid leave wages. So if you have any of that going on, you're going to want to exclude that. So that was kind of what they call the cash compensation. The next, there's another section called non-cash compensation for payroll. And part of that is the qualified healthcare costs. So the key here is to make sure we're only including the employer portion of the healthcare, so not the employee paid portion, because that would be a little bit of double dipping. So these costs need to be paid during your covered period, so whether it be the 8 weeks or the 24 weeks. These are the pre-tax amounts included in your gross wages. So they include all the typical stuff: dental, vision, HRAs, FSAs, but not the HSAs. So here, it's also important to remember we can't include the prepaid premiums and contributions to health plans. Those are not included. Otherwise, anything paid during your 8 or 24-week period is covered. Another payroll cost that we can include is the retirement contributions. And again, we're talking about the employer paid portion. And it's anything paid during the 8-week or the 24-week. But remember that you cannot be prepaying these 401k matches. Now, if you have 2019 contributions that had not previously been paid, you can go ahead and pay those during your cover period, and that would be fine. However, you can't go and prepay these matches for later periods. Okay, so we'll get into the restrictions for owner employees here. An owner employee is defined as any owner employee owning over 5% of a C Corp or an S Corp, or any 5% member, greater than 5% member of an LLC, any greater than 5% partner of a partnership, and then all sole proprietors. So we talked a little bit before about the cap on these owner employees, but it gets a little more detailed as you drill down to the type of entity. So C Corp owners are limited to 2.5 months of their 2019 W-2 income plus their 2020 employer portion of health and retirement. You get down to the S Corps, and they're limited to, again, 2.5 months of their 2019 W-2 income, and then they can include retirement, but not health for their 2019. So continuing with that last slide, we'll talk about the general partners. Again, they're limited to 2.5 months times. Now, this is where it gets tricky. So you can't just include all of their 2019 income. You've got to take 0.9235 of their 2019 self-SE income less their 179 deductions less unreimbursed business expenses. They cannot include health or retirement. So again, this is where it really gets tricky. If you have questions on these calculations, please feel free to reach out to Terry Bekaert. We've done a lot of these with our clients, and we'll continue to help you through any questions. Sole proprietors, it gets a little simpler here. Again, 2.5 months, 2019 Schedule C, net profit. You can include your health or your retirement. And then finally, for the LLCs, you're going to want to follow the rules for either the general partnerships or corporations. And that'll depend on how you filed your 2019 tax return.
Danielle, that's great. We appreciate it. Hey, one question that I know has been coming up a lot is that we talk about using an 8 or a 24-week covered period. We know there's companies out there that needed more than 8 weeks in their covered period, but they might not need the full 24. Is there an option to apply in less than 24 weeks? And if so, do they still get that full $46,154 salary cap for everyone?
Right, that's a good question. So originally when they came out with the option to do 24 weeks, they were not clear about that. They have since introduced regulations saying, yes, you can apply before the end of your 24-week covered period, provided that you have enough expenses to get full forgiveness. On your second part of the question, again, it's not clear on how to handle that, but if you say use 12 weeks instead of 24 weeks, Sherry Becker, we interpret the guidance that you need to cut that $46,000 in half. So if you're not going the full 24 weeks, you think you can only include 12 weeks. So that would be, rather than $100,000 divided by 52 weeks times 24 weeks, you would just do $100,000 divided by 52 weeks times 12 weeks, or if you're using 10 weeks or 14 weeks. So you're going to want to prorate that down depending on how many weeks you're going to include before you apply for forgiveness.
Great. Thank you.
Yep.
All right. Well, thanks for that overview. And for those of you who have perhaps been on our website and seen other webinars, we have quite a few other PPP-related webinars that we invite you to look at whenever you get a chance. So let's go a little bit deeper now and talk about how PPP can impact government contractors. And obviously, government contractors are in a very unique situation compared to the broader swath of other commercial businesses in the U.S. because of the fact that government contractors, for the most part, have an ultimate end customer who's the federal government, who also has funded PPP. So there are some possible conflicts there that contractors need to keep in mind. The one FAR clause that comes into play with PPP very front and center is this FAR 31.201-5, which is the credits clause that basically says any credit, allowance, or rebate coming back to a contractor related to any allowable costs needs to be credited back to the government, either as a cost reduction or a cash refund. And where this has come front and center with PPP is that if we have a contractor that is borrowing PPP money and later seeking forgiveness, the contractor does need to keep in mind that potentially some or all of that PPP amount may need to be credited back to the government and applied to their contract. So as a simple example here, if a contractor has a $100,000 PPP loan and they've used 90% of that money to cover costs under a contract, which have also been billed to the government during that covered period, then it's possible that that contractor could owe a $90,000 credit back to the government on that $100,000 PPP loan. And we're going to talk now about the different contract types, because there are some areas here that have been made very clear, but there are a larger number of areas that really are not very clear. So first, we'll talk about what seems to be pretty darn clear, and that is cost-plus contracts are clearly covered by that FAR clause in Part 31 that we just referenced. And DOD has come out with guidance that has reinforced this, saying that allowable costs, which are billed to the government and also a contractor is claiming those same costs for forgiveness under a PPP loan, DOD's been very clear to say that that contractor owes a credit for those forgiven costs back to their agency customer. In essence, under cost type contracts, if a contractor is using PPP money to fund billable costs, be they direct or indirect, then you will owe a credit back to the government for those amounts. And from a practical standpoint, we've been asking clients we've talked to, why even use PPP money for that? Because essentially there's no benefit to the company, and all you're doing is creating administrative work for yourself to A, claim forgiveness, and then B, later have to work with your agency customers to give them a credit. So in the world of cost-plus contracts, we strongly advise against claiming forgiveness on any direct or indirect costs that are either being directly billed or a part of a cost pool that are indirectly being billed to the government. To us, just makes no sense to even use PPP money for this. Then let's talk about time and materials contracts, which are pretty close to cost type contracts in some ways, but not so close in others. Here, there is no clear guidance in FAR, and there has been no clear guidance provided by DOD or any other agency. Thus, we have had contractors ask us whether PPP money can be used to cover direct or indirectly allocated costs under T&M contracts. And there really is no guidance here. Our firm's view is that because these are flexibly priced contracts, at the very least, we'd say it's very risky to use PPP money for expenses under these contracts. And our advice is to not claim forgiveness on either direct costs under T&Ms or indirect costs being allocated to T&Ms. But we would be open to looking at certain specific instances, and we know we've advised a lot of clients to also seek advice from their attorneys on this matter. We just think this is going to be an area of great contention between contractors and the government. And then where it gets probably even murkier is in the world of fixed price contracts. And most everyone knows there are different types of fixed price contracts. Firm fixed price, where perhaps you've got a contract where you're providing a service or a good at a fixed price, could be per unit, could be per month. There are fixed price level of effort contracts. There's fixed price contracts where you're actually producing a product that's sold to the government at a fixed price. And here, even after hearing opinions from a number of law firms around the area, there does not seem to be an overwhelming consensus on how to approach fixed price contracts. We believe that the fact pattern behind the contract makes a great deal of difference, and even how your proposal was written and how the contract is being administered may make a difference into whether PPP money can be used to cover the costs under certain of these contracts. For the most part, we feel like if you're in the production business, if you're in the manufacturing business and producing products on a fixed unit price, then probably it's okay to use PPP money to cover costs under that contract. And if you're in a true firm fixed price environment, that may also be okay to use PPP money to cover costs under those contracts. Fixed price contracts that really behave and are administered more like T&M contracts, that's where we think it gets a lot more risky to use PPP money and to seek forgiveness for costs under those contracts. But there are a lot of nuances here, and we believe contractors, together with their accountants and attorneys, need to look literally at every single contract, and in some cases, task orders under those contracts to determine which costs probably are the least risky to seek forgiveness on, and which ones are more risky. Companies need to consider their role as to whether they are a prime or a sub. If you are in the prime contractor role, obviously you have responsibility for the performance and other factors applying to your subcontractors. So if you have, whether you're a small or large business, if you're a prime, we encourage you to be in communication with your subs to find out, did they get PPP money? How is this contract structured? Are they planning to seek forgiveness for any of that PPP money? And you will need to make some decision as to whether you believe that that sub may owe a credit back to you, the prime, that in turn you may need to pass on to your agency customer. And likewise, in the situation where you're a subcontractor, if you have a PPP loan and you're seeking forgiveness on all or a portion of that loan, you do need to consider how this is impacted by your contract type and whether you want to be in communication upward to your prime to discuss your responsibility of perhaps flowing credits up to the prime, who in turn will need to flow them through to the agency customer. We have had a number of questions over the last several months from contractors about, well, if I have a PPP loan and I'm seeking forgiveness, do I need to seek forgiveness on the entire loan? Should I seek forgiveness on just part of the loan? Very clearly, you do not need to seek forgiveness on the entire loan. There is nothing at all wrong with applying for forgiveness on a portion of the loan. And our strong advice to contractors has been to consider using their PPP funds to only cover the direct and indirect costs for which they have not been able to bill during their covered period. So if there have been some changes in the work scope or some downtime for direct people, then it's certainly fine to cover those labor costs for those direct people during the time they were not billable, have them charge their time to some type of an unallowable or non-billable labor code, and cover those costs with PPP money. That to us seems like the cleanest way to use PPP and to seek forgiveness. Likewise, we believe it's perfectly fine, and in fact would be encouraged for contractors to consider taking any indirect labor costs together with other forgivable expenses such as rent or utilities that are not being billed to a contract and being removed from a cost pool such as an overhead or a G&A pool, moved to an unallowable, non-billable code, and covering those costs with PPP money. If that's a way to manage indirect rates and keep them where you are budgeting them for the year, we think that's a good use of PPP money, and we're available to talk further about what's the right way to manage the accounting for that and the documentation for that, so that if you are audited later on, either by SBA, DCAA, or any other cognizant agency, that you've got a good documentation package to show the appropriate use of PPP money. And the last point we make here is that if you've been following any of the news in the Post, the Washington Business Journal, and Wall Street Journal, and other publications, you will know that there has already been a pretty fair amount of press attention on the fact that government contractors have been getting PPP money. And we have had the question quite a bit as to what to do with the unforgiven portion of a PPP loan. Should it be repaid right away, or should it be amortized over the allowed 2 or 5 year period? And there is no clear-cut right or wrong answer here, but we've encouraged people to, as we say, consider the court of public opinion and take a look at, are you prepared, if you claim forgiveness on part of your loan and not the rest, if you were to receive that theoretical phone call from a reporter at the Washington Post, how are you going to respond to that inquiry about how you've used PPP money, and have you been doing any kind of behavior that would be viewed as detrimental to the taxpayer in the treatment of that loan? And a couple other considerations, final considerations here with regard to use of PPP. Just remember, if you have employees that work OCONUS, PPP money cannot be used to cover any wages or benefits for those employees. PPP money is only used for wages and benefits paid to employees whose primary residence is in the U.S. That does not speak to citizenship or to tax home. It's simply defined as primary residence, regardless of citizenship. And lastly, for those government contractors who do operate a true commercial business or division within their company, where the government is not the end customer at all, well, PPP money can be used to support any kind of wages, benefits, rent, utilities, any of the other eligible expenses that have been outlined. PPP money can be used to support those expenses all day long, and that has no bearing on the contract type. Hope that's helpful in thinking about your different contract types within your company. I'm now going to hand it off to my partner, John Ewer, to talk about the tax implications and some of the tax issues that have arisen in PPP. So, John, over to you.
Thanks. So as important as all of these issues and considerations are that John and Danielle have explained, they become doubly important when you realize these decisions feed into your tax situation. And that, with everyone scrambling to understand how the PPP program works, the tax implications have been a little bit neglected. And so we'll touch on a few issues here in this presentation, how Congress set up the program, subsequent IRS interpretation of that legislation, and then currently unaddressed issues that could impact 2020 and 2021. So a question that some contractors have asked us is, when we receive the proceeds of a PPP loan, is that a tax recognized event? And the answer is no. This is because there's a corresponding obligation to repay the loan, the IRS does not consider this income right now. And so there's no income that needs to be reported in the moment that you receive those loans proceeds. It's not a recognition event. Loan forgiveness is really where the meat of the tax issues are. And so just to kind of walk through the philosophy, that the tax policy on some of these issues is generally when debt is forgiven, the borrower recognizes income. It's called cancellation of debt. And the policy behind that is a taxpayer has been released from an obligation to repay the loan, and it's an accession to wealth, and so that should be taxed. And that's settled tax law. That's pretty common. The CARES Act, there was Section 1106I excludes PPP loan forgiveness from cancellation of debt income inclusion. So that's not taxable when a PPP loan is forgiven. And this is a unique provision that we don't see often. It was meant to be very taxpayer friendly. So people were excited when that initially came out in the CARES Act. What happened later is the IRS issued a notice. It's Notice 2020-32, and it almost backdoored the benefit that taxpayers are receiving from this legislation, because it caused that deductible expenses, otherwise deductible expenses that are paid with PPP loan proceeds, would not be deductible on their tax return. And so this was not part of the legislation. Congress did not instruct the IRS to take this stance. The IRS took it on their own. The idea behind it is that forgiven PPP loan proceeds are similar to tax-exempt income. It's income that in this case, contractors are receiving and they're not having to pay tax on. So it sounds like it's that type of income. And in that situation, we have tax-exempt income, no deductions are allowed, because that would be, you're essentially double dipping. You're not having to include the income on your return, so you shouldn't be able to take the deductions with it as well. And so from a tax policy, that makes sense, but it ends up hurting taxpayers in the long run. When the IRS came out with the notice, there were several members of the House and the Senate that publicly came out and condemned the IRS for this position, said that it was clearly contrary to congressional intent, and to the extent where we had a lot of letters going into the Treasury Secretary to either change the ruling or change the guidance, or to correct it with a later guidance. So far, that has not happened yet. There's also seen many industry and professional groups. I think the last count is up to 170 different groups, including the AICPA, which for accounting firms, that have been lobbying for this correction. Some congressmen, women and men have put together an act. It's called the Small Business Expense Protection Act, and it's been introduced in the House and later in the Senate. And the specific reason for this legislation was to correct this issue and to allow the deductions. Currently, this legislation is still in committee in both the House and the Senate. And with the current political environment we find ourselves in, including the debates over the second stimulus bill, and now increasingly high political tensions, it's unclear where the future of this act lies. But right now, it's been tabled. So the reason this is an issue, what the IRS has done, is because it effectively creates a tax for recipients of a PPP loan who use the proceeds to pay deductions that otherwise would be deductible. So essentially, the non-taxability of cancellation of that income with disallowed deductions, which is what we have here, is the same as if Congress hadn't acted and we had taxable COD income plus those deductions being those expenses being deductible. So it's really a net sum game at this point. What the IRS has done, they negated any progress or any benefit taxpayers, contractors would have received otherwise from this CARES Act legislation. A quick example, simple example, is if we have a contractor with $10 million of income, say they have $6 million of deductible expenses, they have and would have been expected to have $4 million of taxable income. Well, normally, without this special provision in the CARES Act, if they received a $3 million PPP loan, and it was forgiven, then that would be cancellation of debt income. And so that would have been included in their income. So we have the $10 million of regular income plus the $3 million of PPP loan proceeds. They still would be able to expense the full $6 million, and they're left with $7 million of taxable income. What we see in the CARES Act, the congressional intent was for the $3 million COD PPP loan to be forgiven and still receive those deductions. So as you can see, we have the $10 million of income, we have the $6 million of expenses, and we're back to the $4 million of taxable income. What the IRS notice did, obviously, is it allows, because of the congressional letter, the intent of Congress was very clear in that the cancellation of debt be forgiven, but it disallowed the deductions, which essentially left taxpayers with, in this example, with $7 million of taxable income. And we may ask, well, in the net, maybe it doesn't make sense. But when you're considering the planning that has gone into this year, for example, 2020, a lot of our contractors are C corporations or they're S corporations, and they are making estimated tax payments. Well, if they've made tax payments based on $4 million of taxable income, that's very different than what we receive now under this notice, where we may have, in this example, $7 million of taxable income. And this is really how it affects you as contractors. It's the net, that disallowed deductions that we don't see many people paying attention to, because we're worried about the forgiveness, we're worried about qualifying and all of the different expenses and how they're affecting our PPP loans. But from a tax perspective, we could be left with a large tax bill at the end of 2020 because our income is higher. And this is obviously a case-by-case scenario. It depends on what the contractor has been doing in 2020. If their income is about the same, but they received a PPP loan and they're receiving some of those loan proceeds to pay off the deductions, it could be very possible that they have a much larger tax liability and at the end of 2020 than they expected. And if they've underpaid their estimated tax payments, and there's additional penalties and interest that are tacked onto that. And if we're dealing with, in this example, it's only $3 million, those are still some pretty hefty penalties and interest. And in many cases, we're dealing with much larger sums. And so some owners could be caught by surprise if we're not doing this planning ahead of time. There's several unanswered questions when it comes to how these deductions will be allowed. Some of the ones that we're keeping an eye on and trying to find out is the timing of forgiveness. So many contractors took out a PPP loan in 2020, but due to the loan forgiveness cycle, that probably won't find out if that loan is forgiven until 2021. Well, now we're wondering, how do we report the PPP loan and expenses on a 2020 tax return when we don't know what portion of those are going to be forgiven, which ones are necessarily going to be allowed? And so we're trying to keep a close dial on our contractors and how they're handling this year so that we can predict and accurately report 2020 as best as possible. Another example is if we assume that income reported on a 2020 tax return and we haven't, we didn't allow those disallowed deductions based on the IRS notice, theoretically the SBA has 6 years to audit these PPP loans. And in this example, if we receive a denial in 2025, the statute of limitations to amend our 2020 return has been closed. And so in this scenario, we didn't take the deduction up front for the PPP expenses, and now it's too late to amend to take those deductions, but we still have to repay a PPP loan amount that we initially didn't anticipate. And so we could be left kind of whipsawed with the way the IRS guidance has come out, plus the SBA audit. And so there's just a lot of issues we need to keep track of and be aware of as we move forward. So to conclude, it doesn't look like the IRS is done with the PPP loan program. So we're looking at future updates, clarifications, potential regulations to come out. The underlying message, probably from our standpoint, is that 2020 and 2021 are going to be very volatile years. We need to make sure that you're working with your tax advisors. And a couple of solutions that might pop up is we might see some reporting trends happen if we don't get any more guidance from the IRS or from Congress. Very smart people will decide what is probably the best avenue, and the majority of the country will kind of follow their lead, and there'll be a wide lane, and usually we'll pick the middle one and go down that, and so we'll know what those reporting habits look like and direct contractors to them. Some reporting positions could be a little more aggressive, and if that's the case, we may need to file a Form 8275, which tells the IRS we're taking a stance that there is guidance against, but we still have a reasonable stance to take here. We have reasonable proof that this is an accurate and legal position to take on a tax return. And another option is potentially if we get a letter from counsel stating that this position is supported by the plain language of the CARES Act and with the legislative intent. So when big dollars are concerned, when we have a big issue, those are some options we can turn to. Hopefully we get some more guidance. But for now, the best thing to do is to keep our ear to the ground and plan as best we can going forward.
Well, John, thanks so much. That is great. And for those of us who are not tax professionals like you are, we appreciate the pretty plain English version of all of that. That was great. Now I'm going to hand it over to my partner Craig Hunter, who's going to talk about the GAAP accounting side of PPP. So, Craig, it's over to you.
Thank you, John. Hello, everybody. So, accounting for the PPP loan. We're going to start talking about the basic accounting and then talk a little bit about the accounting for any credits due back to the government. So the pure GAAP treatment would be really to apply the provisions of ASC 470. So under ASC 470, one treats the proceeds as a financial liability, which is really the same guidance as applicable to any other debt. Importantly, though, one would not need to accrue and record the imputed interest, as the stated interest of 1% is currently less than the current market rates. The loan would remain a liability until such a time as legal release has been obtained from the bank and the SBA, i.e. the loan was forgiven. So remember, this could be as much as 5 months after the application goes in. So at this time, which is upon legal release, the loan will be forgiven and a gain on extinguishment would be recorded. And then at that time, a benefit would flow through the income statement. An alternative treatment has been sanctioned and considered acceptable, which is really to account for the transaction in accordance with International Accounting Standard 20, IAS 20. IAS 20 outlines a treatment for different forms of government assistance, including forgivable loans. And under this model, the government assistance is recognized when there's reasonable assurance that 1, the conditions will be met, and 2, the assistance will be received. Reasonable assurance here is really similar to the word and the term probable in the context of GAAP. So once this reasonable assurance has been met, the earnings impact will be recognized on a systematic basis over the period in which the entity recognizes, as expenses of course, the related costs for which the grants are intended to compensate. So the original entry would be a credit to deferred income, the debit obviously going to cash, and then subsequently liability would be reduced with the offset impacting the income statement either as an other income or perhaps as a reduction to the actual expense at the time the expense is incurred. So most companies we've spoken to are really in favor of applying the provisions of IAS 20, as this will really allow some income statement benefit in the short term. The application of ASC 470 would not allow any benefit until that full legal release is obtained, which again is when the forgiveness is granted by the bank. So if forgiveness hasn't been obtained by the company's year end, and we're dealing with some June and September year ends now, then no benefit could be recorded. And some companies are going to want to record that. Now, remember, as it relates to credit, a credit will only come into play when the loan has been forgiven. So let's run through a couple of scenarios here. So number one, let's say you build the government or your prime and the PPP funds are being used entirely or exclusively for direct and indirect costs. In other words, costs that have been billed back to the government. Like John mentioned earlier, this will be in the 100% cost-plus environment. And in this situation, many contractors are simply electing to repay the loan in full and really not to have to deal with the administrative burden of either applying and getting forgiveness and then having to provide a full credit back to the government. If you're in this situation, this is by far the easiest way to account for these circumstances. Remember that if you have applied IAS 20 and you've taken some from an internal accounting position, you might have taken some benefit to the income statement previously, and that you're going to have to want to reverse, which will leave you with a liability equal to the original loan that you took out. The second scenario is the company has billed the customer and received forgiveness for the costs that were eligible under PPP, but perhaps not eligible in the context of a government contract. So remember, if you've received forgiveness under either ASC 470 or IAS 20, you would have recorded a full benefit in the income statement for the funds received back. So the next and potentially the most difficult and complex calculation is really determining that credit due back to the government, as John has spoke to a little bit earlier on in the presentation. Once this credit has been determined, then an accrual needs to be recorded and expensed through the income statement. When the government is paid back, the accrual just goes away. It's just like a normal accrual. So importantly, the benefit flowing through the income statement is only for the total amount forgiven, less any expected credits that one expects to have to pay back to the government. The third scenario, which is really a blend of a situation where you expect to get some level of forgiveness but have not yet received forgiveness. If you've applied ASC 470, again, you're going to have to wait until legal release has been obtained. So if you've got a year end between incurring the costs and getting forgiveness, there's no positive impact to the forgiveness on the income statement. If you've applied IAS 20, you'll have taken some benefit to the income statement for the amount that you expect to get forgiven. And as in the previous scenario, you need to determine, are there any amounts that have been billed to the customer for which forgiveness will not ultimately be obtained? And you'll want to accrue that amount that you expect to have to pay back to the bank. So in summary, one should really always have an accrual equal to the credits you expect to have to pay back plus any amounts you don't expect to get forgiven. That should be the sum of your accrual. The income statement impact would again depend on whether you adopt ASC 470 or the provisions of IAS 20. So some best practices here, all mentioned before, I think, but really worthy of repeating because they really are so important. And the first one is documentation, and our guidance and our guidance would be to maintain documentation at the lowest possible level for where and how PPP funds have been used. That'll just allow you to build your documentation for forgiveness a lot easier. And again, communication with your contracting officer and your prime, let them know that you received the PPP funds, just enter into a dialogue. And lastly, just understand the level of participation by any of your subs and the impact that may have on your contracts. Thanks, John.
Craig, thank you. No, we appreciate that. That really concludes what we have today. Hopefully we've answered a lot of your questions. We are sure we have not answered them all because we keep getting questions really all the time from contractors about this area, and there's still I think as we've said, there's still a number of murky areas out there that hopefully will get clarified as time goes on, but no guarantees. I want to thank my co-presenters, Danielle, John, Craig. Thanks so much. You've got our contact information here. We are receiving questions here as we go, and we will get to those and get answers back to you as quick as we can. And we thank you for your participation today, and have a good rest of the day.